Imagine a company steps up to the microphone and announces they are officially the fastest cloud provider in history to reach $5 billion in annual revenue.
Right, which is just a monumental milestone.
It is. And they are boasting this jaw-dropping 110% year-over-year revenue jump for the quarter. Plus, to top it all off, they announce a contracted revenue backlog of $66.8 billion.
Yeah, that is a number you really have to pause and process.
Exactly. So you would think that is the ultimate victory lap, right? But then almost immediately, their stock price plummets by 18%, dropping down to $79.56.
Which just feels completely backwards.
It does.
Right.
How exactly does a company report a quarter that massive and still trigger a massive sell-off?
Well, it really is a phenomenal contradiction. On one hand, you have a business executing at a scale that the infrastructure world has rarely, if ever, seen. I mean, they're literally overrun with customer demand.
Right.
But on the other hand, you have Wall Street having a sudden, severe panic attack over the sheer cost of sustaining that hypergrowth.
Welcome to the Deep Dive. Our mission today is to figure out that exact disconnect. We are looking closely at CoreWeave's Q4 2025 earnings report, digging into the earnings call, the financial releases, and the market data from a truly wild day of trading. Okay, let's unpack this. We need to figure out what CoreWeave's wild trajectory actually means for the future of AI infrastructure and why Wall Street is having a panic attack over a company that seems to be drowning in customer demand.
I think to really understand what happened here, we have to look past the top-line shock value. My goal today is to guide you through not just what these staggering numbers are, but why they actually matter to the broader ecosystem.
Yeah, the physical reality of it all.
Exactly. We are going to connect CoreWeave's aggressive physical expansion to the underlying mechanics of the global AI boom. Because if you want to understand where artificial intelligence is going next, you can't just look at the models. You have to look at the concrete, the steel, and the power agreements making those models possible.
Let's start with the sheer scale of the growth, because the momentum they are reporting is, frankly, hard to wrap your head around. CoreWeave's Q4 revenue hit $1.7 billion.
Just in one quarter.
Just one quarter. For the full year of 2025, they generated $5.1 billion. That is up 168% year over year. CEO Mike Intrater proudly pointed out that they are the fastest cloud in history to hit that $5 billion mark.
And rightfully so.
But honestly, as massive as that is, it's not the number that dictates where this company is going.
No, it really isn't.
Right.
The gravity of this earnings report centers entirely around that $66.8 billion revenue backlog. And it is crucial to understand how that backlog is structured. This is not some speculative projection of future demand or a soft pipeline of interested leads. These are contracted take-or-pay agreements.
Meaning the customers are legally on the hook to pay for that compute, whether they actually utilize all the capacity or not.
Exactly. It guarantees the revenue.
All right.
And what is even more telling is the duration of these commitments. CFO Nitin Agrawal noted that the average weighted contract length has jumped from roughly 4 years to about 5 years.
Wow, a full year jump.
Yeah, that shift is incredibly significant. It tells you that the biggest players in the AI space are locking in their infrastructure for half a decade at a time. They view this level of compute as foundational to their long-term survival, not just a temporary expense for some experimental project.
And if you look at who is actually signing these massive multi-year deals, it's not just the giant hyperscalers anymore. The customer base is broadening out significantly. In the fourth quarter alone, CoreWeave added twice as many new reserved instance customers as they had in any previous quarter. We are talking about major AI native and enterprise companies. The call specifically highlighted Cognition, Cursor, Mercado Libre, Midjourney, and Runway.
It's a huge shift in the market.
It really feels like the entire tech ecosystem is realizing they need to secure this infrastructure now or risk being left behind.
And they are securing it well before the infrastructure is even fully built. It is an outright land grab for computing power.
Speaking of securing computing power, there is a detail on the call regarding older hardware that really caught my attention. You would naturally assume that with these incredibly complex next-generation AI models, every single customer is fighting exclusively for the newest, most bleeding-edge chips.
Right. You'd think everyone just wants the H100s or Blackwells.
Exactly. But the pricing data tells a completely different story.
What's fascinating here is that the demand for prior generation GPUs, specifically the A100, is so relentless that the pricing dynamics have completely inverted.
Which is nuts.
It is. Normally, as hardware ages and newer chips hit the market, The older generation gets significantly cheaper. But demand is so strong, largely driven by inference workloads, that A100 pricing actually increased in 2025 as CoreWeave wrote new contracts.
It is wild to see a previous generation chip actually get more expensive. It just goes to show how compute-hungry inference has become now that these models are actually out in the wild interacting with millions of users every day.
Yeah, the real-world usage is driving that up.
Meanwhile, they noted that the average pricing for the newer H100 chip in Q4 stayed within 10% of where it started the year.
Which firmly puts to bed any lingering concerns Wall Street might have had about the demand for older generation hardware drying up. The utility of the A100 for inference at scale is clearly extending the profitable lifespan of that silicon far beyond initial projections.
And CoreWeave is capitalizing on that by making sure they capture these customers across their entire ecosystem, not just renting out raw compute. Roughly 80% of their million-dollar-plus customers have now adopted one or more of CoreWeave's storage products.
That ecosystem lock-in is vital.
Plus, they are making some highly strategic acquisitions to widen their moat. They acquired a company called Monolith to expand their capabilities into the physical world and manufacturing sectors. They also bought Marimo, which unifies generative AI developer workflows. They are deliberately building a very sticky platform.
That is a critical transition. They're moving from being a specialized infrastructure vendor to becoming a comprehensive development platform. When a customer is relying on you not just for the GPUs, but for their storage architecture and their core developer workflows, the switching costs become astronomically high. You lock them in.
Which brings us to the operational side of the equation. Delivering on a $66 billion backlog requires a physical footprint that is truly mind-bending.
It really is.
By the end of 2025, CoreWeave reached 850 megawatts of active power across 43 different data centers, and they brought a massive 260 megawatts online in the fourth quarter alone.
We really need to pause and appreciate the sheer engineering complexity of that reality. Bringing 260 megawatts online in a single 3-month window is an extreme feat of execution.
Yeah, that's not just flipping a switch.
Not at all. It is not just about plugging in servers. It requires orchestrating the hardware, the complex networking topologies, the storage arrays, and the proprietary software across more than 100,000 GPUs simultaneously.
The scale is so massive that management cited third-party estimates indicating CoreWeave is now larger than the 15 largest neoclouds across North America and Europe combined.
And that ability to execute at such an unprecedented scale is exactly why they are winning these massive 5-year contracts. When you are operating hundreds of thousands of interconnected system components, delays and disruptions are a statistical certainty. What separates a Tier 1 provider is how they mitigate those disruptions.
Right, and what impressed me on the call was how quickly they resolved the data center delays they had warned everyone about in the previous quarter. They didn't just catch up, they ended up delivering over 50,000 Grace Blackwell GPUs to impacted customers on a rolling basis.
Getting them fully operational in mere weeks.
Exactly, weeks after getting access to the data center infrastructure. They executed so well on the new architecture that they actually became the first cloud provider to reach NVIDIA's exemplar cloud status for the GB200.
That relationship with NVIDIA is really the cornerstone of CoreWeave's entire narrative. It has evolved far beyond a typical buyer and seller dynamic. NVIDIA actually expanded their commercial relationship with CoreWeave this past year, which included a direct $2 billion investment into the company.
A $2 billion investment from the company making the chips. That is the ultimate vote of confidence. But wait, it goes deeper than just capital, right?
Much deeper. CoreWeave isn't just renting out NVIDIA hardware anymore. Over the years, CoreWeave has developed a highly proprietary software stack, specifically their SNK and mission control platforms, which essentially acts as the operating system for their entire cloud infrastructure. NVIDIA now intends to test and validate this software platform so it can be included within their own reference architecture.
Which means CoreWeave could start licensing their management software to other clouds.
Precisely. They could license it to sovereign clouds being built by nation-states or massive enterprise private clouds. And this is vital for you to understand because software margins are traditionally 80 to 90% compared to the highly capital-intensive business of building physical data centers. CoreWeave's management explicitly noted that this software licensing represents a massive, higher margin source of revenue that isn't even factored into their 2026 financial guidance yet.
Okay, here's where it gets really interesting. Because if you are listening to this, you have to be wondering, They have a $66.8 billion guaranteed backlog. They are executing flawlessly on a physical scale that makes their competitors look microscopic. They have NVIDIA investing $2 billion and essentially turning them into the operating system for global AI infrastructure.
Right. The setup is perfect.
So how in the world does Wall Street look at all of that and decide to dump the stock by 18%? Why did their earnings per share miss expectations so badly, coming in at a loss of 89 cents per share?
The answer lies entirely in the brutal financial mechanics of hypergrowth. Wall Street loves the idea of growth, but they're notoriously terrified of the upfront costs required to achieve it.
The sticker shock.
Exactly. During the call, management announced their capital expenditure, or CapEx, guidance for 2026, and the number they put out was a staggering $30 to $35 billion.
Wait, 30 to 35 billion? With a B? They only generated 5 billion revenue for all of 2025. How does Wall Street look at a CapEx number that is roughly 6 times their current revenue and not immediately panic about bankruptcy?
Well, that is exactly why the stock dropped. To understand that panic, you have to understand how data center financing actually hits a balance sheet. When a company like CoreWeave commits to building new infrastructure, the cash goes out the door immediately. They have to secure the land, sign the power purchase agreements, buy the cooling systems, and purchase hundreds of thousands of GPUs.
All before they make a dime back.
Right. All of that triggers massive depreciation expenses, facility leases, and operational costs that hit the income statement long before the data center is fully online and the customer starts paying their monthly invoice.
So it's like paying the massive mortgage, the property taxes, and the utility bills on a skyscraper while it's still being built, months before the tenants can actually move in and start paying rent.
That is a perfect analogy. The costs are entirely front-loaded while the revenue is distributed over a 5-year contract. Because CoreWeave is aiming to roughly double their build-out capacity in 2026 compared to 2025, the CFO warned that the first quarter of 2026 will represent a massive trough in their profitability margins. The ratio of their upfront costs relative to their recognized revenue will be at its absolute worst. We already saw hints of this dynamic in Q4 of 2025, where their GAAP net loss was $452 million.
And that's before we even talk about the debt, because building $30 billion worth of infrastructure requires an ocean of capital.
Yeah.
Throughout 2025, CoreWeave secured over $18 billion in debt and equity.
It's a staggering amount of leverage.
They utilized convertible senior notes, expanded credit facilities, you name it. And holding that much debt carries a phenomenal price tag. Their projected interest expense for just the first quarter of 2026 alone is expected to be somewhere between $510 million and $590 million.
If we connect this to the bigger picture, it becomes very clear why CoreWeave's management is entirely unpanicked by that margin trough, even if Wall Street isn't. From the inside, they view this entirely as success-based spending. They aren't spending $30 billion on a speculative gamble, crossing their fingers that customers will eventually show up to rent the servers.
They already have the customers.
Exactly. They're deliberately investing ahead of revenue to capture and service that $66 billion take-or-pay backlog. The debt is essentially secured by the foundational AI workloads of the biggest tech companies in the world.
Right. The demand is already locked in, and if you dig underneath that massive CapEx spending and the heavy interest expense, the core engine of the business is actually incredibly healthy. Look at their adjusted EBITDA for Q4, which strips out the heavy depreciation of the data centers and those non-cash accounting variables. It was a very strong $898 million, representing a 57% margin.
That is a very healthy margin for infrastructure.
It is. Plus, even though they took on massive amounts of new debt, they successfully lowered their weighted average interest rate by 300 basis points over the course of the year. Nitin Agrawal pointed out that this efficiency alone saves them roughly $700 million annualized.
Which proves that as CoreWeave matures and their track record of flawless execution grows, the capital markets view them as significantly less risky. That operational credibility is what allows them to refinance and borrow at much better rates, which is crucial when you are financing tens of billions in physical infrastructure.
Agrawal also pointed out a massive non-cash tax benefit this quarter tied to the One Big Beautiful Bill Act. And regardless of where anyone listening stands on the politics of that legislation, from a purely financial perspective, we're just looking at how volatile tax rates and government incentives are actively reshaping the balance sheets of these infrastructure giants. The company explicitly warned that their effective tax rate will likely fluctuate significantly in the future due to these exact kinds of legislative variables.
It is a vital reminder that no business operates in a vacuum, especially at this scale. Corporate tax structures, legislative incentives for domestic manufacturing, regional energy policies, these external factors filter directly down into the bottom line. When you are deploying $30 billion in capital, a shift in tax policy can alter your GAAP profitability by hundreds of millions of dollars in a single quarter.
So what does this all mean? Why should you, listening to this right now, care about the intricacies of CoreWeave's CapEx strategy or their adjusted EBITDA? Whether you are a developer building the next generation of AI agents, an investor trying to navigate the tech sector, or just someone trying to comprehend the sheer scale of the AI revolution, CoreWeave is the ultimate bellwether. Their financials prove, beyond a shadow of a doubt, that artificial intelligence has firmly transitioned out of the purely experimental software-focused phase. It is now a massive, heavily contracted, multi-billion-dollar physical infrastructure industry.
The future of AI is quite literally being poured in concrete, wired with fiber optics, and connected to the grid right now. And CoreWeave's aggressive future targets give us a clear roadmap of where they believe this physical reality is heading. They expect revenue of $12 to $13 billion in 2026, and they're aiming to exit that year at an annualized run rate of $17 to $19 billion. Looking further out, they are projecting an annualized run rate of over $30 billion by the end of 2027.
And they are systematically locking in the ecosystem at every possible level to ensure they hit those numbers. They announced a major global partnership with CrowdStrike to bake zero-trust security directly into the foundation of their cloud. Enterprise clients won't migrate their most sensitive AI workloads without that kind of metal-level security.
Security is non-negotiable at that scale.
Absolutely. They also launched CoreWeave Federal, officially joining the Department of Energy's Genesis mission to advance discovery science and national security compute. Government contracts are some of the stickiest, highest margin deals on the planet. They're interweaving themselves into the very fabric of the modern economy.
They are positioning themselves not just as a hardware vendor, but as an indispensable utility. Much like the telecom companies in the early days of the internet, or the power companies during the Industrial Revolution, CoreWeave is attempting to become the foundational layer upon which the next era of technology is built.
It is truly fascinating to untangle the complexities of their massive upfront spending versus this unprecedented contracted growth. Thank you for joining us on this deep dive to look past the scary 18% drop in the stock ticker and really understand the massive economic engine driving this company forward.
I want to leave you with one final thought to mull over as you watch this space evolve. We've talked extensively today about CoreWeave's current operational scale of 850 megawatts. But looking at their roadmap, their objective is to add more than 5 gigawatts of additional data center capacity beyond their currently contracted footprint by 2030. Try to conceptualize that scale, 5 gigawatts. As AI companies race to build exponentially bigger, faster, and more complex models, we have spent the last few years obsessing over whether there will be enough silicon chips produced to power them. But looking at the sheer raw scale of CoreWeave's expanding physical footprint, the real question for the future of artificial intelligence might be this: will there literally be enough electricity generated on the planet to keep it all plugged in?
That is a staggering thought to end on. It puts the entire AI race into a completely different perspective. Thank you so much for tuning in. Keep exploring, keep reading, and most importantly, keep questioning the physical realities of the tech infrastructure around you. We'll see you next time.